All right, continue with the scenario 2 of September December 20 exams. And now what we have to look at, requirement B, based on the financial statement provided, calculate the following ratios and comment on the financial performance and position of the car group for the years ended 31st December 2008 and X7. We have to calculate gross profit margin, operating profit margin, ROCE, return on capital employed, current ratio, and gearing ratio, that is debt divided by debt plus equity. It wants in this way. Maximum of 5 marks is available for the calculation of ratios. So that means 5 marks for ratios, 8 marks for comments. Okay, bang on. We have to calculate, we have revenue with us, we have cost of sales, gross profit, admin expenses, distribution expenses, operating profit or loss. We have current assets, equity, current, non-current liabilities and current liabilities. Okay, the majority of the non-current liabilities is comprised of bank loans. Okay. Sale of the single company represent 14% of the total group sales for 2000 exit. However, in March 2000 exit, single company lost a significant customer contract, resulting in a number of redundancies. This redundancy cost amounted to 15 million and included admin expenses. Overall, single company made an operating loss of 17 million. The car group manufactures food packaging. The inventory included in the above consolidated statement of financial position is group inventory at 65 at 2000 exit, and then X7 it was 78. The December exit, single company had inventory of 42 million. Anything else? No. Okay. So again, new sheet. Now, firstly, what we have to do for B part, we have to compute the ratios. Okay. 2000 X8, 2000 X7, we have profitability ratios, in which first we have gross profit margin. Okay, for 2000 exit, it's equal to sum 124 divided by 289. Gross profit 124 divided by revenue, which was 289. Okay, multiply by 100, we'll get 42.90, 657 something. Now for 2007, let us compute 2000 is equal to sum 132 divided by how much? 272 multiply by 100, 48.52, 941. Operating profit margin 64 divided by 289 multiply by 100. Oh, sorry, is equal to sum 130. Yeah, 64 divided by 289 multiply by 100. 22.14 is equal to sum 96 divided by 272 multiply by 100. So we get 35.294. You can write 35.3%. Okay, next we have ROCE. ROCE, how to compute it? Operating profit divided by equity plus non-current liabilities is equal to sum 64 divided by 621 plus 100 . Oh, yes, 64 divided by 621 actually, plus 100 million. Okay, second, just a second, just a second. You're right. Right. So our ROCE for 2000 X8 is 0.088766. You can say 8.9%. How I got it? You can see in my formula 64 million divided by 621 million plus 100 million, the non-current liabilities, and I got it like this. Let us do it for 2000 X7 as well. Is equal to some 96 million. Okay, divided by 578. Okay, 578. We will add 150 million, the non-current liabilities in it. Bracket close, and again bracket. We'll get 13.18. You can say 13.2%. Right. So far so good. We have computed two ratios. Now we will compute our liquidity ratios. That is current ratio and gearing ratio. Is equal to sum current assets 112 divided by current liabilities, which is 36. 3.1 is to 11111, or you can 3.1 is to 1. Next, we have for the next year, the current assets were 125 is equal to 125, the current assets divided by current liabilities, which were 161 or 161 actually. 0.77639. You can say 0.8 is 2 times 1. Next, gearing ratio, which will be debt divided by debt plus equity, and how much we will get is equal to some 100 divided by 100 plus 6 to 1. Okay. 0.138 that means it is 3.13.9, and finally for the last year it will be equal to some 150 divided by how much? 150 plus 578. Just a second. Yeah, done. 20.6 will be our gearing debt ratio for the 2007, and now financial performance. We got our 5 months. Now we will work for another 5 months. Right. Now what we will say that consolidated revenue has increased from 2000 X7 to 2000 X8 despite the loss of sinker companies, significant customer contract 3 months into the financial year. This might that and increase in the revenue of a company or its other subsidiaries or its other subsidiary or both, right? Yum has more than compensated for single company lost revenue. Right. Further, what we will say, however, even though the group revenue has increased, the gross margin profit has fallen by 5.6%, and the group cost of sales is higher than 2007. This is likely to have been impacted by the poor performance of sinker company. Okay. Now, as sale of sinker company represent 14% of the total group sales, this poor performance will also have impacted on the group operating margin. Operating profit margin has dropped significantly from 35.3% to 22.1%. Admin expenses have almost doubled from 23 million for the year ended 2007 to 45 million for the year ended 2008. Part of this increase is due to 11.1 million loss on disposal of sinker company. The administrative expenses will also have increased as a result of the 15 million staff redundancy costs and impairment of goodwill. Okay. ROCE has fallen from 13.2% to 8.9%, but this figure is hard to interpret as the return includes the results of sinker company, including the loss on disposal and impairment of goodwill. But the capital employed does not include the capital of sinker company due to the disposal at the year end. The operating loss made by sinker company of 17 million plus the loss on disposal of 11.1 million and impairment of 4.9 million will have a reduced operating profit. Although it is a simplification, removing these balances would result in group ROCE of 12.9%. Now you might be wondering that how it will happen. So let me do it for you. Is equal to sum 64 million plus 17 million plus 11 million plus 4.9 million Okay, divided by 621 million plus 17 million plus 11.1 million plus 4.9 million bracket close plus 100 million. Okay, so this is how it will happen, and yeah, okay. All right. So further, what you will say, which is more in line with the 2000x7 figure. Sorry, it is. Just a second. Let me retype it. Okay, 64 million plus 17 plus 11 plus 4.9 bracket close, new bracket open, 621 plus 17 plus 11.1 plus 4.9 plus 100 bracket close. Okay. Now, finally, financial position. Now, what we will say in it, the current ratio considerable improvement for the year ended 2006, following the disposal of Sinker Company. The group was in net current liability position at the end of 2007. This would suggest that Sinker Company may have had a large bank overdraft balance or high levels of payables at 31st December 2008. It would appear that the sale of Sinker Company has improved the liquidity of the group. It should be noted that 2008 group current assets of 112 million will include the 20 million consideration for single company. This could be used to settle some of the long-term debt. Bank loans already decreased by how much? How much? Yeah, 50 million. There is no information about the long-term loans of the sinker company. Now, finally, something about gearing. Gearing has been reduced during the year from 20.6%, but without further information on sinker company non-current liabilities, it is very difficult to tell if this is a result of the disposal or whether Calco has simply repaid debt during the year. Now, in the end, what we have conclusion for this requirement. Okay. What will be the conclusion for the requirement, the inclusion of single company in the consolidated statement of profit or loss does not appear to have had an adverse impact on revenue generation, but now that Car company has disposed of the poorly performing subsidiary, it might be able to better control costs, thereby improving gross and operating profit margin. Sinker company appears to have been a drain on the liquidity of the group and the position of the group appears to be much healthier following the disposal of Sinker company. So that's the conclusion for this part, and we are done with the second part. Now we'll do the next part.